Hi traders, this is Houston from the Trading Edge and the Montreal Traders Meetup. In last week's lesson, we spoke about the importance of capping your losses as an intraday trader. That's one of the key principles that we're going to be talking about at this month's meetup. In this week's lesson, we'll be addressing one of the trickier trading environments which cause many a trader to lose money or give back their market gains, and that is the range-bound market or the rotational market. Now, most traders love trading trending markets. These are the easiest markets to trade in the sense that there's usually sufficient range for most participants to catch some profits. On the other hand, a lot of traders, especially newer traders, have a hard time dealing with range-bound or sideways markets. So if your style is to trade momentum, that is, you're trying to buy or sell breakouts, you're trying to ride winners, or maybe you're trying to buy or sell pullbacks to see new highs or lows, then this is usually a losing style in a rotational market. And that's because these types of markets make sharp reversals that will chop you up. Whether you go long or short, the ranges just aren't sufficient enough to cover your losses. And here's the problem, right? Most studies and experience shows that markets typically only trend about 70 to 75% of the time. So what do you do? So you really have two choices. Number one, you look for opportunities elsewhere. If the instrument or market that you're looking at is displaying range-bound or rotational qualities, then you have to find better markets if that's not your style. Or number two, you have to have the flexibility of changing up your trading strategies to deal with those range-bound markets. Now here's what doesn't work. Many traders, they make the mistaken or have the mistaken belief that they can somehow zoom down to a lower time frame and avoid that chop. And the issue is that the market at a lower time frame just generates an abundant amount of trade signals for most systems. And most traders end up just simply getting lost in that chop and the sharp reversals that characterize a rotational market. That is, it's very easy to get lost in that noise and lose track of the bigger picture. You may not see you're in a bigger uptrend across several days or weeks or months because intraday, if you're trading a small time frame chart, you're just flipping back and forth both sides and usually getting a bunch of paper cuts. So in rotational markets, you have to recognize that you will have fewer opportunities. That is, if you choose to trade them. And that the size of those opportunities will also be smaller. And that your best bet is to trade back into the range. That is, to fade highs and lows back into an area of perceived value. Now, this past Wednesday and Thursday, the SPY, the S&P ETF, gave an excellent example of the difference between trending and rotational markets. Let me bring up a chart here. So on Wednesday, and this is right here on 17th, this is a 30-minute chart of the SPY. We had a really powerful trending session. And then the next day, Thursday, we basically had a mirror opposite of a really good example of a rotational session where price basically grinded sideways. I drew a yellow box around Thursday session, and it basically grinded sideways for most of that trading session. And it also did the same for many individual stocks and equities. They also had the similar rotational profile. So the question is, how do you begin to identify when a market could be range-bound versus trending? So this is what we're going to be talking about for the rest of the video here. I want to share a couple of principles and highlight a few techniques which you can use to begin to piece together the puzzle to help you identify a range-bound or trending market so that you can adjust your trading style, i.e., are you going to trade a different market that's not exhibiting these behaviors, or do you change up your trading strategy and trade and stop trading momentum and kind of pullback strategies? So note, nothing that I'm going to be describing here is either fixed in stone or mechanical. We're simply trying to play the odds, and we're thinking about things in terms of probabilities, and that's a winning mindset. So the first part to begin to, when we try to put this puzzle together, is to begin to analyze the broader market context. And this is what I like to do. So when when I begin my analysis of any market that I'm going to be trading in, I usually start with the wider time frame. So at the bottom right hand corner we have a monthly chart. On the bottom left hand corner we have a weekly chart. The top right hand corner we have daily, and in the top left hand quadrant we have a 30-minute chart. And so if we begin at the bottom here on the monthly, we'll do this quickly because we don't have that much time to go into it. The monthly on the SPY, as we all know, we're in a very long bull market now, and the trend is absolutely up, right? You can see since April of 2017, we've had nothing but green months. We had one small red month back in March of 2017, but other than that, January has been an exceptional start to the year. Likewise, on the weekly time frame, we've had exceptional amount of green weeks. Going back to 2017 and beyond that, and that's clearly an uptrend, even without putting in the moving averages and that kind of stuff. And on the daily, this is what I like to begin to bring your attention to, right? So the 17th was this bar here. The 18th was that bar. Now we have some small blue bars underneath, which simply allow me to visualize better an inside day. An inside day is one of the most important pieces of market generated information. It's a very objective signal in the sense that all it's telling you is that we have a bar that is currently within the range of the previous bar. That means the high is lower than the previous high and the low is higher than the previous low. And this means that we're basically in an equilibrium or finding value. So when you begin to see that, you have to begin to be a little more wary, as we don't have yet the a close outside of the previous day's range to show that we're going to have range extension. So let's go to the day to the lower time frame now, right? So let's go on to the 30-minute chart, and I'm going to go ahead and expand that. So we're looking at the 30-minute time frame, and this is the next thing I want to highlight. So again, we talked about it already. The Wednesday of last week, the 17th, excuse me, there was a phenomenal trending session, right? Basically, the market went up nearly all day, and it petered back a bit towards the end of the day, and then the next day it just basically traded sideways. Now, just to highlight what I'm talking about here, so the 18th was the choppy day. If we were to zoom in on, let's say, a 2-minute chart, and this is where a lot of traders can get kind of lost in the chop. Let's go to the 18th now. We'll pull it back to the 18th. So a lot of traders in this sequence here that's traded in, that's highlighted in yellow, they're getting hurt, right? So this is the type of day where the reversals are sharp and swift, and if you're trying to use some sort of directional trend following based approach, you're really going to get in big trouble, right? If you're long here into the open because you think that the yesterday was a good a trending day and it's going to continue, you're wrong right away. It jams against you. You try it again, it works against you, so you try to go short, jams up, jams back down, jams back up, goes sideways for a good 2 hours here. Then if you think it's going to head back down again, it quickly jams back up. And if you think finally it's going to break to the upside, you're wrong, and it jams back down against you, right? So unless you're the type of trader who's very agile, very flexible, trading this type of time frame or this type of chop or range bound trading, it can be difficult. So the beginning thing is to understand is that we're when we have the larger context, we now know that we're trading as an inside day. Okay, so we have an inside day sequence, right? And we're after the previous day. So let's talk about the range bound day here. We had a really strong trend session, and so for this trend to continue, it really has to continue above the previous day's range. Here, as an example, we get our second piece of information. Okay, so the second piece of information that I like to use a lot is to better understand the actual open. So I've never understood why some people characterize the final hour as the most important trading hour of the day, because I believe that one of the most important pieces of market generated information is that first hour of trading, or the opening range. And there's basically 4 types of opens, and we're going to talk more about this at the meetup next Wednesday. But the 4 types are: number 1, the open drive; number 2, the open test drive; number 3, the open rejection reverse; and number 4, an open auction. And so if we look back at the trending day, what did we see? We actually saw an open drive type of day. So Wednesday's session turned into a trading session, into a trending session, because we opened inside the range. So in the beginning, this, you have to begin to think it could just be a range bound day because you're currently inside the previous day's range. However, what's happened is that in the first 30 minutes of the session, and then the first hour of the session, we quickly break out of this range. So you can look at the first 30 minutes or the first hour's range, and if we can take out that range, then that will set the tone and the tempo for the rest of the day. So we can see here, even though we opened up inside the range on Wednesday, on the third bar at 11, we broke through, and that's when, you know, the action really began, and you were able to basically just get long and hold it for most of the day, right? Now contrast this with Thursday's open. So Thursday's open, if you were long overnight, or you came into the morning thinking that things could go even higher, you were, unfortunately, quite disappointed. So if you take a look here, we open up in the range, but unlike the previous day's example, the first hour, actually this, the green bar is the first half an hour, the red bars, the end of that is the first hour. We basically trade within this for a long period of time, right? And this shows us right away that, versus this, the previous day's open was, we call that an open drive. So basically opens and then drives away from the open. This would be called an open auction, where literally the market is using price discovery to try to find a place of value. So it probes downwards, tries to find some value down here. Some buyers finally step in. We have a bit of a hammer put in there, and then it drives back up again, and then it finds a bit of excess there, and then it promptly pushes back down back into this area. And that's when you begin to see that your best strategy, once you can identify that it's going to be an open auction, is to fade the ranges, right? You're not looking for breakouts to the downside. You're not trying to play breakouts to the upside or look for pullbacks. You're looking for the market to begin to show extremes like here, and then getting back into the range, right? So as we mentioned already, trading range-bound days are going to have fewer opportunities, and the opportunities are going to be smaller, but they're there, and you can easily capitalize on them when you have the right perspective. So one final piece that I like to personally use to visualize and to take advantage of these range-bound sessions is a tool called Market Profile. And I can't distill all the principles of Market Profile in this video, but one of the main principles of Market Profile is that in Market Profile, we recognize that price is just an advertising mechanism for opportunities. So let me say that again. Price is an advertising mechanism for opportunities. So if you ever wondered why you ever felt so compelled to trade, it's because of this reason. The auction market, the markets themselves, are basically a place to tempt people to chase opportunities. So in order to break free from these temptations of focusing on just price, users of Market Profile focus on trading market structure or trading value. And so when the markets are trending, we look to trade away from value. And when the markets are range bound, we look to trade back towards value. So let me just quickly open up a Market Profile example here to give you a better understanding of what that looks like. So if you've never seen Market Profile before, then let me just quickly explain what this is. And if you have more questions about Market Profile, I would suggest you Google it, because there's a wealth of information online, and it's more than I can cover in this short video. But basically, in Market Profile, each one of these letters is called a TPO, or time price opportunity, and it represents 30 minutes. Okay, so it represents 30 minutes. So this is a Wednesday session that had the trending session, right? So at 9:30, this is the range that it covered. At 10 this is the range that was covered. At 9:30, 10:30, 9:30, 10, 10:30, 11, 11:30, and so forth, right? And we see that the market quickly breaks away here and starts trending for the rest of the day. Now contrast this with this profile on Thursday, all right, where we have a market that's basically bouncing up and down, bouncing up and down. And on Friday, we had a very, very similar type of rotational market, except at the end of the day, it took off to the upside. What I want to highlight to you, if you're trading, if you're new to market profile, is this particular, I'll just draw it in here, is this particular line right here. This purple line that I'm highlighting right here, if I'm right underneath it, it's called the POC, or the point of control. And this line represents what the market profile users would think of as value. This is where price spent the majority of the day. That is, the majority of the day, we had 5 or more points where price basically hung out. So basically, if you think about how you use market profile, or how they calculate this, they would take price times time, and that would be equal to value. So anytime price touches an area repeatedly, this builds the value. So that means there's an efficient market or auction that's going on there, and that we would characterize as having value. So this line here that I'm basically underlining underneath here, this is the POC, or the line of value that we had on Wednesday. And we can quickly see that, once we can identify that, it's very easy to trade back into those ranges, right? So this is a great opportunity if you're fast or have the understanding, is to trade back into value. So you take these extremities and you fade and go back in towards value again. And this worked very, very well on Thursday session. So as I mentioned before, in rotational markets, we want to be trading back towards value. When things are trending, we want to be trading away from value. That is, we don't care as much about value because people are paying up for price, paying up for to get filled. Whereas in trending markets, we don't want to be paying up and chasing. We want to be fading it and going back towards the perceived area of value. Okay, so one more example of this, and this is what happened on Friday. So one small tip is that if you're new to market profile, then anytime we see price hit a level for, let's say, more than 5 instances, so you have 5 TPOs or 5 of these letters touching price consecutively, there's a good chance it's going to be a rotational day, right? So now when I see this here, where I see each one of these TPOs or letters, basically touching this area, right, then I begin to see that this could be basically a rotational day. It's not like this day here where price doesn't hang around for a while in one area. It quickly gets away from there because the price discovery is probing to the upside. It happened again on Friday, right? We had a number of touches on this line here. So let me draw the line back here again. You can see it right there. We had a number of touch points on that line, and price basically went back and forth. If you were trying to trade this directionally, you would have got really hurt, right? If you're looking for breakouts here, you would have been wrong right away. You're looking for shorts down here, you're wrong right away. And likewise, it finally worked at the end of the day here, but for how long, right? So this is what I talked about earlier in the video, is that we're playing the odds and the probabilities, not necessarily looking for outliers, because I know most of the time price will revert back to value. So the very powerful concept, and I'll leave this with you, is that price will tend to revert back to these areas of value if they're not reclaimed again. So in this case here, the next day we had the strong POC. The next day it was revisited right away on the next day's open. Now look what happened on Friday. We have a very prominent, again, POC, and we have price now above it. So I would say that if price were to come back in a bit, there's a very high chance that on Monday or very soon we will have this level, 279.65 on the SPY. It will get tested again, right? Because that's a perceived area of value. So I hope that helps. In this video, we talked about 3 things to summarize. Number 1, understand the difference between trending markets and rotational markets, and be flexible enough to adjust. Either look for other opportunities or change your trading style. Number 2, use the broader market context to help align your trading. So use the monthly, weekly, daily market structures to help you understand what's going on around the bigger trend. Okay, so on a day like Wednesday, you don't want to be going short on a day like this because the markets are telling you it's up. You don't want to be looking for shorts. And if you're looking for shorts, they probably need to be scalps. Okay. Number 3, we want to be using the open as another piece of valuable market-generated piece of information. Okay, we talked about the 4 different types of opens. And lastly, number 4, we talked about the power of using market profile and not being lured by price and instead trading value in market structure. I hope that helps. If you have any other questions, reach out to me at houston@thetradingedge.org. Happy trading.